Alrighty, so what we're going to do now is the following. I first will introduce you to the 7 mechanics of the business model, and the mechanics are actually those things that make business models resistant over time. And then we'll spend just 10 minutes to look at your models and see, given these mechanics, how well do you think your models do today? Which of these apply to them, which of them don't? And after that, we will wrap up with looking at actually what you've produced. And we'll have lunch. Okay? Good? Great. So, 7 mechanics. I'm going to move here because I want to point out what they affect. Number 1, switching costs. So switching cost is everything that has to do with your customer and how easy it is for him to go to somebody else. I've mentioned to some of you about hooking customers and locking them in. So lock-in mechanisms that make it difficult for them to switch will fall into this mechanic. Second thing, recurring revenue. Having recurring revenue is good. It makes your business model very resistant. So, right here. Earn before you spend. This number 3 affects actually the structure of this and these over time. In other words, can you do just-in-time manufacturing? Are you able to take in money and produce very quickly? So not have a delay between the time you earn something and the time you spend it. Yeah. What you don't want is the other way around. So having to spend stuff that you haven't earned yet. Right? Game-changing cost structures, that's one thing that gets affected usually with disruptive technologies. And that affects this, but also comes from some of these elements. An example, everything that has to do with digital has affected dramatically exactly this element, so the cost structures, because copying has become extremely easy and doesn't cost anything. So this kind of technology changes are going to create this kind of cost structures change. So that's something to watch for. It's a mechanic which is a negative mechanic. In other words, you need to watch for changes that may be making something that costs a lot today very easy to produce. When you talk about this kind of cost structure changes, we are not talking about little changes. We're talking about order of magnitude changes. Other stuff you can discard. Getting others to do the work, again, something that affects this part of the equation. We've mentioned some of these elements, so getting your customers to do part of the work, getting people to do work for free, as in the open source type of development and so forth. Of course, that decreases dramatically your cost. Scalability. That's something that is not usually looked at in the business model, and that has to do with how good is your model over time and how much can you scale it. What it affects is a number of different elements. This, meaning, do you have enough scope to scale? Is your segmentation big enough to actually be able to scale? And this, which is, are you able to actually produce that scale? An important element in the scalability is your relationships, because they do not scale easily. And the last one is protection from competition. The protection of competition has to do a lot with how easy it is to imitate this and how easy it is to set up these. So can somebody else implement the same technologies, have the same infrastructure, and deliver the same value proposition? So these are the 7 mechanics. Now what I would like you to do is just take 10 minutes to look at your models and see, do they apply to your model or not? So is your model fit for business over the long run? Is it very resistant? And then we'll just go around the tables and see what actually you've produced with each of these models, because they're very different.